we're just showing markets on a week-to-date decline. Looks like they're going to finish this week lower. I want to ask you, I want to get your opinion. Is it the rising bond yields putting pressure on stocks, or is it earnings not really wowing investors? We got to keep in mind the S&P is trading at about 24 times forward earnings. I don't want to use the F word, but a lot of people say it's kind of frothy.
Well, the way we think about it is certainly bond yields have been a bit problematic, but it's really about earnings. And it's really getting back to this concept of the weighing machine that Benjamin Graham has talked about many times. In the short run, the market's a voting machine. In the long run, it's a weighing machine. And as long as earnings are strong and continue to build, and what we've seen from companies thus far is that they are delivering. It may be not quite as good as people had hoped, but it's still pretty strong. And certainly for the large names and some of the names that have really driven the stock market so far this year, they continue to produce.
All right, so you believe earnings are pretty strong, but we haven't even got really to the meat and potatoes of this market right now. That's big tech earnings. We had Tesla. Tesla kind of had a pop, and still the markets are down week to date. Next week, we get the hyperscalers, a lot of big companies that have a lot of weighting in the S&P and the NASDAQ. So what are your expectations for that? How do you see the market reacting if we get kind of what we're getting here? Earnings mostly meeting expectations. You see right here, EPS 6% above earnings expectations, revenue just about 1% above expectations.
We think the market's going to trade pretty much in a range over the next couple of weeks. Obviously, we have earnings coming in. We have the election coming up in just under 2 weeks. So between those two, we just think that it's probably going to be a little bit choppy through here. But as long as we see next week that the earnings come in at least on par with what is expected, we think that the market can move higher through the end of the year. And seasonally, November and December are typically quite good for the U.S. stock market.
All right, we focus a lot on the U.S. markets here on the show. You're looking for opportunities in emerging markets. We're going to show a chart here. Since the Fed rate cut, if you look at the MSCI Emerging Markets Index, it is outperforming the S&P since then. In your mind, what's the catalyst to keep that going? Here in the U.S., we're about to get, expecting to get another rate cut. Also have a very strong economy. A lot of that push for the emerging markets, that seemed to be that China stimulus. Do you think the emerging markets, they continue to outperform?
We think they're going to be choppy, similar to the U.S. right now. But what we think is that if you look at over the next couple of months, if growth is able to pull through for some of the emerging markets beyond China, when you start to look at India, when you look at Brazil, if those other countries can continue to deliver, then maybe China won't be quite as much of a driver of the performance of the EM. At the end of the day, it's still the 800-pound gorilla, though, when you think about overall size of economy and market. And so we do need to see some of this stimulus stick, and we need to see the Chinese government continue to invest back into the economy for that economy to continue to grow at the level that we've seen over the last decade.
You know, also, it sounds like you think it's a valuation play. You point out in your notes that the MSCI Emerging Markets Index is trading at about 12 times, the S&P at about 24 times. Alan, we got to go, but I do want to ask you about bonds. So you also like investment-grade corporate bonds. I want to ask you, I'm just using two products from a guest that we had yesterday just to kind of keep it in context. If you look at the bond blocks, BBB rated 1 to 5 year corporate bond, that has about a 3% dividend yield. And then you look at their high yield ETF, that has about a 10% dividend yield. Why do you like investment grade, high grade better than the high yield right now? I mean, we just pointed out the economy is really strong. It seems like there's a lot less risk of these companies defaulting. Why not go for the yield on the high yield side?
We think it's about the future and being mindful of the future. And when you think about the next 12 to 18 months, as the economy slows, where we get back down to a pre-pandemic level of growth in GDP, they're going to start to struggle a little bit more on the high yield side. We think that quality companies with stronger balance sheets, that investment grade type of bond, they're going to perform better in that type of environment. We know that spreads are tight in both categories, but we just think that investment grade offers a little bit better of an opportunity and a little bit less risk than on the high yield side, despite, as you note, the higher yield level in high yield.